Friends, you can check out our presentations on YouTube channel. JCF Pune is the channel name. Yes, now we are live on YouTube also. Pranay, you can continue.
Thank you, Mavi sir. Jai Jinendra, and good morning to all the chartered accountants present in this meeting. I myself, Pranay Oswal, is glad that I'm having this opportunity to present on the topic residency test of individuals in India. I'll just share my presentation. So today's topic, residential status of an individual. As everybody knows, residential status is determined by Section 6 of the Income Tax Act. Today, it is important for the Income Tax Department to determine the residential status. Also, as rightly said by Santosh sir, it becomes particularly relevant during the tax filing season. Based on the residential status, the tax liability differs. And today, in today's meeting, we are going to explore the residential status and taxability in details. This is just a rough index of what we are going to have. So residential status in today's self-explanatory presentation, I've tried to cover the amendments which are falling during the century, right from 1922 till 2020 budget. So it will have evolution of residential status, followed by meaning and importance, determination of residential status, divided in three categories: resident, resident, not ordinary resident, and non-resident. Followed by, I have also tried to cover a gist of taxability based on the determination of 3A, 3B, 3C, and the latest amendments in the provisions related to determination of residential status of an individual. So evolution, we can trace back the evolution of this section, residential status in India, right from the Income Tax Act 1922 in the terms of Section 4A. So let us see what this act says. Prior to coming in force of Income Tax Act 1961, the residence of individual was determined in terms of Section 4A of Income Tax Act 1922. The provision read as follows. The residence in the taxable territories for the purpose of this act. An individual is resident in the taxable territories in any year if he, now there are four provisions which determine the taxable residential status. If he is in the taxable territory in that year for a period amounting in all to 192 days or more, or maintains or has maintained for him a dwelling place in the taxable territory for a period or periods amounting in all to 182 days or more in that year, and in the taxable territories for any time in that year, or having within the 4 year preceding that year been in the taxable territories for a period or period amounting in all to 365 days or more in the taxable territories for any time in that year, otherwise than an occasional or casual visit. Or if he is in the taxable territories for any time in that year and the concerned income tax officer is satisfied that individual having arrived in the taxable territories during that year is likely to remain in the taxable territories for not less than 3 years from the date of his arrival. Thus, basically, there were four criteria initially for residence in India, including one that is dependent upon the discretion of the tax officer. Initially, physical presence or the factum of maintenance of a dwelling place along with physical presence in India for a criteria period were the main criteria. This was at the time of era where India was undivided. With adoption of Income Tax Act 1961, the discretion of tax officer was removed and the principle based use of the expression occasional or casual visit was replaced with a specific test. In the course of time, this specified period got modified and the source of legitimate tax planning started. The definition of newly enacted 1961 Act was as follows. Residence in India. For the purpose of this Act, as determined in Section 6, an individual is said to be resident in India in any previous year if he is in India in that year for a period or period amounting in all to 182 days or more, or maintains or causes to be maintained for him a dwelling place in India for a period or period amounting in all to 182 days or more in that year and has been in India for 30 days or more in that particular year, or having within the 4 years preceding that year been in India for a period amounting in all to 365 days or more is in India for a period or periods amounting in all to 60 days or more in that year. Thus, as we have seen, there were initially 4 tests for residency, and now, as mentioned earlier, also the discretion of income tax officer has been removed. So we are left with 3 alternatives. Thus, there were now 3 alternative criteria for residence. If any of these were satisfied, an individual was said to be resident for a particular year. To summarize, it are like follow: either stay in India for 182 days, stay of 30 days in that year if a dwelling place is maintained for more than 182 days or more in that year, and stay of 60 days in year if the individual had been in India for at least 365 days or 1 year in any of the all 4 preceding years. These criteria were rather stiff, and in terms of Section 5, the worldwide income of the resident was taxable at that time. Then came the first change in the scheme of the things was brought in 1978. It was by way of relaxation in the respect of Indian citizens who were employed or engaged in other vocation outside India. A certain explanation was added for those people who were employed outside India or engaged in some other vocation outside India. So the explanation is as follows: in the case of an individual being a citizen of India who is rendering services outside India and who is or has been in India on leave or vacation in the previous year, the provisions of subclauses B and C shall, in relation to that year, as if for the words 30 days and 60 days respectively occurring in the said subclauses, the word 90 days had been substituted. Also, I would like to clarify that citizenship is not linked with residential status. Citizenship was a criteria was thus added for the first time, although by way of relaxation of the rules. But still, an individual may be resident and end up being non-citizen or vice versa. Further, to get the benefit of the additional 30-60 days of stay in India, as the case may be, without being resident of India, one had to be citizen of India who is rendering services outside India and who is on leave or vacation in India during the next year. The next important change happened in 1982. The finance minister in his budget speech stated that the test of residence in India, laid down for taxation purposes, resulted in hardship to Indian citizens earning income in foreign countries who come to India for short spells. An individual is regarded as resident in India in a year if he stays here in that year for 30 days only and also maintains a dwelling place or a house here for 180 days or more. As this test causes hardship to persons working outside India who come home even on a relatively short visit, I propose to delete this test of the residence. Under another test, persons who have been in India for 365 days or more in the 4 years preceding the relevant year become resident in that year by being in India for 60 days or more in that year. In case of Indian citizens who are employed abroad and who come to India on leave or vacation, the period is 90 days. I propose to extend this benefit also to the self-employed and those in occupation, irrespective of their vocation abroad or the nature of visit to India. So basically, Indian citizen.
Pranay,
Yes,
Pranay,
sir. Yes, sir.
can you just slow down your pace a bit because you are reading from the script, no?
Okay, sir.
You need, yeah,
I'll
just
just slow down.
pause in between.
Okay, sir. Okay. So this amendment was basically added to give a relaxation benefit to extend the benefit to 90 days for the people who were employed outside India or Indian citizens who were in abroad. So Indian citizens who go abroad for the purpose of employment are now chargeable to tax in India on their foreign income if they have stayed in India for more than 60 days that a year. I propose to liberalize the provisions so that the Indian citizen who leaves India in any year for the purpose of employment shall not be treated as a resident unless he has been in India for 182 days or more in that year. So this was basically the speech that was added by the finance minister and the amendment during that year. We will now analyze what the amendment was. As a result, the subclause B of section 6.1 was omitted and the explanation was substituted as follows. The explanation is, in the case of an individual being a citizen of India who leaves India in any previous year for the purpose of employment outside India, the provisions of subclause C shall apply in relation to that year as if for the words 60 days occurring therein, the words 182 days had been substituted. Who being outside India comes on a visit to India in any previous year, the provisions of subclause C shall apply in relation to that year, as if for the words 60 days occurring therein, the words 90 days had been substituted. So this additional benefit has been given to persons who are employed outside India but who comes to visit in India, and initially they were allowed only a very short spell. So this relaxation was basically for the two categories of individual: those who leave India for employment could stay in India for 182 days in the year on leave or on vacation without being resident of India. This was the first. And the second one was for the Indian citizens who come on visit to India. They could stay in India for 90 days in a year, although being non-resident. As a result of these amendments that were meant to benefit Indian citizens employed abroad, the criteria of residency now entirely depended on the period of stay in India. So as we know, initially it was based on discretion of income tax officer. Then the discretion was removed, a specific test was made, and now it was depended entirely on the stay in India, how many days a particular person is staying in India. And this would cause problem in future. And clause C was made virtually redundant in case of those Indian citizens who leave India for the purpose of employment outside India. Next year in 1983, an important development happened, although there was no change in residency rule then. The first phase of tentative opening up in the 80s was necessitated by the need for investment in convertible foreign exchange to tide over the difficulties in balance of payment. So basically, in 1983, people understood that non-resident Indians who are having, or persons of Indian origin who are having their investments in India, it was very difficult to justify this rule for them. So a special chapter 12A was introduced in the Finance Act 1982 for non-resident of Indian origin. In fact, the term non-resident Indian was coined for the first time and defined in section 115C as one who being a citizen of India or a person of Indian origin who was not a resident of India. The explanation stated that a person will be deemed to be of Indian origin if he or either of his parents or any of his grandparents was born in undivided India. Thus, NRI and person of Indian origin, this both the definitions came for the first time. NRIs were therefore privileged by having a lower rate in respect of their investment income, including capital gains from shares, etc. The NRI then started to demand that the period of free stay of 60 days in that year, if a person has been in India for 1 year in the last 4 years, or the period of free stay of 90 days in the year when someone comes on visit to India for a short, was too short for those NRIs who had to supervise their investment in India. Therefore, in order to enable NRIs to stay for a longer period to look after their investment without losing their non-residential status, the explanation was substituted and read as follows. Explanation: in the case of an individual and being a citizen of India who leaves India in any previous year for the purpose of employment outside India, the provisions of subclause C shall apply in relation to that year, as if for the words 60 days occurring therein, the words 182 days had been substituted. And being a citizen of India or a person of Indian origin within the meaning of explanation to clause E of section 115C, who being outside India comes to visit in India in any previous year, the provisions of subclause C shall apply in relation to that year, as if for the words 60 days occurring therein, the words 150 days had been substituted. So basically, this amendment had happened for those NRIs because it was very difficult for them to maintain their investments in India, and they had to frequently travel to India, visit to India to maintain their investments. So this amendment was for those people. By the Finance Act 1990, there was further an amendment in the residency rule. Residential status of an Indian seaman who sail on high seas was not free from doubt. Therefore, by way of abundant precaution, they were then specifically included in clause A of the explanation, which now read as follows. Explanation: in the case of individual being a citizen of India who leaves India in any previous year as a member of the crew of an Indian ship as defined in clause 18 of section 3 of Merchant Shipping Act 1958, 44 of 1958, or for the purpose of employment outside India, the provisions of subclause C shall apply in relation to that year as if the words 60 days occurring therein, the words 182 had been substituted. Being a citizen of India or person of Indian origin within the meaning of explanation to clause E of section 115C, who being outside India comes on a visit to India in any previous year, the provisions of subclause C shall apply in relation to that year as if for the words 60 days occurring therein, the word 150 days has been substituted. Basically, the effect of these amendments was further dilution of clause C of section 6(1). For NRIs coming to India to supervise their investment in India, there was still a difference of about a month that remained. The explanation earlier applied to Indian citizens working abroad who came to India on visit. This would not have covered those NRIs who were not citizens, whereas under section 115C, since the term NRI also included persons of Indian origin who could also be foreign nationals, person of Indian origin as defined in that section was incorporated in section 6 as well. Then in 1994, the clause B was again amended. This time with specifically the NRIs in mind, and the period of 150 days as seen earlier was now substituted in with 182 days. The reference which the finance minister has made in his budget speech is as follows. Representations have been received from non-resident Indians that they should not lose their non-resident status even if they visit India and stay for more than 149 days. I propose to raise this period of stay to 181 days. The explanatory memorandum to the finance bill under the head Measures for Rationalization and Simplification had a specific subhead extending the period of stay in India in case of non-resident Indians without losing their non-residential status. It was mentioned that NRIs who have invested in India find it necessary to visit India frequently and stay here for the proper supervision and control of their investment. The period of stay for such NRIs was thus extended, and if their stay in India was up to 180 days, they would not lose their non-residential status. In other words, clause 6(1)(c) now becomes redundant for this group of taxpayers also. So basically, for NRIs, initially the term was 150 days. So there were various representations from non-residential individuals that they need to come to visit India frequently, as mentioned earlier, for managing their investments, and they should not lose the residential status even if they stay in India for more than 149 days. And henceforth, the amendment was made, and the number of days was increased to 182. So now the period of stay for NRIs was 182 days, and still they will not lose their non-residential status. So after all this, from 1994 to 2015, there was basically no change in the aforesaid residency rules. Then in 2015, my explanation was divided into two parts. Explanation number 1 basically continued with the old explanation, and explanation number 2 was added that said that the period of voyage in respect of the member of the crew of a foreign bound ship would be determined according to the rule number 126. In other words, the basic test of residency remained unchanged for over a quarter of a century till 2020. So in 2015, only one explanation was added for the member of a crew of a foreign bound ship. So we can say till 2020 quarter, there was no material substantial change in the residency rule. In the meantime, the whole world, including India, has changed. Instead of a country trying hard for mobilizing foreign exchange to pay for its imports, India now had a sizable foreign exchange reserve. The liberalization of the economy saw immense gain, and new generation of the entrepreneurs evolved in the globalized world. Many of them took liberal advantage of the stay-based residency requirements, which would be easily avoided by just not being present in India for less than 182 days. Some Indian entrepreneurs started investing abroad in a big way, and instead of NRIs visiting India, tending to their investment in India, it was the other way around, and they were tending to their investments abroad by being absent from India for the prescribed period. It was in this background that the budget 2020 urged in changes in the residency rules that came as a rude shock to the non-resident Indians. The finance bill proposed 3 amendments to section 6. One of these related to the class of not ordinarily resident and is discussed subsequently. The other two were in explanation 1 in clause B, for the words 182 days, the words 182 days was proposed to be substituted. 120 days was proposed to be substituted. This would thus directly affect the NRIs for whom earlier that the time period was progressively increased. More damagingly, for the tax planners, the budget made a radical proposal of deemed residency by inserting after the clause 1 of section 6 the following clause 1a. Notwithstanding anything contained in clause 1, an individual being a citizen of India shall be deemed to be resident in India in any previous year if he is not liable to tax in any other country or territory by reason of his domicile or residence or any other criteria of similar nature. The explanatory memorandum explained the rationale of the new clause by stating that persons were arranging their affairs in such a way that not only were they not residents of India, but they were not resident of any country as well. So this was an international concern as a person was planning so effective that he was not resident in India as well as not resident in any other country. And the provision was introduced as an anti-avoidance measure. There were howls of protest pointing out that the government was betraying the non-resident Indians who had helped India in terms of crisis, and that the deeming provision would override all the provisions, and those who were citizens of India would automatically become tax residents of India, even if they were not resident of India in terms of provision of section 6(1), thereby exposing their foreign income to tax in India. So basically this amendment had a lot of protest from the non-resident, as they were thinking their whole foreign income was exposed to be taxed in India, even if they were not resident in terms of section 6. And in India, in case they were residing that did not live in income tax. So basically, those working in the Gulf region and earning salary incomes would particularly get affected. On the next day, immediately, the government had issued a press release for the same clarification in the presentation of budget. The release was as follows. It reiterated that the section 6(1)(a), which initially contained that notwithstanding anything contained in any of the provisions of the act, this was an anti-abuse provision, since it was noticed that some Indian citizens shifted their stay in low or no tax jurisdiction to avoid payment of tax in India, that the new provision was not intended to include in tax net those Indian citizens who are bona fide workers in other countries. So press release was made by the government that those persons who are bona fide Indian citizens and working abroad, they were not to be included in this tax net. It also stated that in some section of the media, the new provision was being interpreted to create an impression that those Indians who were bona fide workers in the other countries, including Middle East, and who were not liable to tax in these countries will be taxed in India on the income that they have earned there. So basically there was a lot of chaos during the budget 2020. Another explanation was added. The interpretation was not correct, and that in order to avoid any misinterpretation, it was clarified that in case of an Indian citizen who becomes deemed resident of India under the proposed provision, income earned outside India by him shall not be taxed in India unless, so this was the clarification which was added, unless it is derived from an Indian business or profession. So it promised that the necessary clarification, if required, shall also be incorporated in the relevant provision of law. Criticisms continued despite the clarification, perhaps taking into account such concerns. The Finance Act 2020, as finally passed without any debate, has now modified the proposal. After the amendments by the Finance Act 2020, the relevant section should now read as follows. Residence in India. Section 6. For the purpose of this act, an individual is said to be resident in India in any previous year if he is in India in that year for a period or periods amounting in all to 182 days or more. Subsection B was omitted. Having within the 4 years preceding that year been in India for a period or periods amounting in all to 365 days or more, is in India for a period or period amounting in all to 60 days or more that year. Explanation 1. In case of an individual being a citizen of India who lives in India in any previous year as a member of the crew of an Indian ship as defined in clause 18 of section 3 of Merchant Shipping Act 1958, or for the purpose of employment outside India, the provisions of subclause C shall apply in relation to that year as if for the words 60 days occurring therein, the words 182 days had been substituted. Explanation number B. Being a citizen of India or a person of Indian origin within the meaning of explanation to clause E or section 115C, being outside India comes on a visit to India in any previous year, the provisions of subclause C shall apply in relation to that year as if for the words 60 days occurring therein, the words 120 days had been substituted. Explanation number 2. For the purpose of this clause, in the case of an individual being a citizen of India and a member of the crew of a foreign bound ship leaving India, the period or periods of stay in India shall in respect of such voyage be determined in the manner and subject to such conditions as may be prescribed. Notwithstanding anything contained in clause 1, an individual being a citizen of India having total income other than income from foreign sources exceeding 15 lakh rupees during the previous year shall be deemed to be resident in India in that previous year if he is not liable to tax in any other country or territory by reason of his domicile or residence or any other criteria of similar nature. The concession made by the government was thus the introduction of a monetary threshold of income in India below which the deeming provision does not apply, and making it clear that the foreign sourced income of such deemed residents are not within the ambit, not within its ambit. So basically, as there was a lot of misinterpretation, the government had added a monetary limit of 15 lakh rupees above which the deeming provision will be applicable, and those who are having income less than 15 lakhs, the deeming provision was not applicable for them. Let us see the meaning and importance of residential status. The taxability of an individual in India depends upon his residential status in India for any particular financial year. The term residential status has been coined under the income tax laws of India and must not be confused with an individual's citizenship in India. As I said earlier, an individual may be citizen of India but may end up being a non-resident for a particular year. Similarly, a foreign citizen may end up being a resident of India for income tax purposes for a particular year. So it can go both the ways. Also to note that the residential status of different types of persons. In this particular presentation, we have discussed only about the residential status of an individual. We are not discussing the residential status of a firm or a company, or etc. In this particular presentation, we have just covered the individual taxpayer and how the determination of the residential status for an individual taxpayer is made. So for the purpose of the Income Tax Act in India, first, the income tax laws is classifies taxable person as resident, not ordinary resident, and non-resident. So first, this is the chart, residential status. First, we have to check whether he is a resident. If yes, then we have to further check if he is an ordinary resident or not ordinary resident. And the taxability differs for each of the above categories of taxpayer. Before we get into the taxabilities, let us understand how a taxpayer becomes a resident but not ordinary resident, or an NR. Resident. A taxpayer would qualify as a resident of India if he satisfies one of the following two conditions. Stay in India for a year is 180 days or more, or stay in India for the immediately 4 preceding years is 365 days or more, and 60 days or more in that relevant financial year. In the event an individual who is a citizen of India leaves India as a member of the crew of an Indian ship, in the clause as defined in clause 18 of section 3 of Merchant Shipping Act, or for the purpose of employment outside India during a financial year, he will qualify as a resident of India only if he stays in India for 180 days or more. Such individuals are allowed a longer time, greater than 60 days and less than 182 days, to stay in India. However, from the financial year 2021, the period is reduced to 120 days or more for such an individual whose total income other than foreign sources exceeds rupees 15 lakhs. In another significant amendment from financial year 2021, an individual who is citizen of India and who is not liable to tax in any other country will be deemed to be resident in India. The condition of deemed resident applies only if the total income exceeds rupees 15 lakhs and there is nil tax liability in any other countries by reasons of his domicile or residence or any other criteria of similar nature. So these were the conditions of how individual becomes resident. And if he qualifies as a resident, further we have to check if he is a resident and ordinarily resident, or resident but not ordinarily resident. And if an individual qualifies as a resident, the next step is to determine if he is a resident, ordinary resident, or RNOR. He will be ROR, that is resident and ordinary resident, if he meets both of the following conditions. He has been resident of India in at least 2 of the 10 years immediately preceding that previous year, and he stayed in India for at least 730 days in 7 immediately preceding years. Therefore, if any individual fails to satisfy even one of the above conditions, then he would be resident, but not ordinary resident. From the financial year 2021, as we know this amendment, a citizen of India or a person of Indian origin who leaves India for employment outside India during the previous year will be resident and ordinary resident if he stays in India for aggregated period of 180 days or more. However, this comes with a monetary cap. This condition will apply only if the total income other than foreign sources exceeds rupees 15 lakhs. And also, a citizen of India who is deemed to be a resident in India with effect from financial year 2021 will be a resident and ordinary resident in India. Here, important point to note is that income from foreign sources means income which accrues or arises outside India, except income derived from a business controlled in India or a profession set up in India. And if an individual satisfying neither of the following conditions as stated above in A or B, then he would be a non-resident for that particular financial year. I have tried to cover the gist of taxability depending upon the residential status. Taxability of total income of an individual in India depends upon his residential status. A resident will be charged to tax in India on his global income, that is income earned in India as well as income earned outside. NR and RNOR, their tax liability in India are restricted to income they earn in India. They need not pay any tax in India on the foreign income. Also note that in case of double taxation of income where the same income is getting taxed in India as well as abroad, one may always resort to the double taxation avoidance agreement DTAA that India would have entered into with the other country in order to eliminate the possibility of paying taxes twice. So if same income is getting doubly taxed, so one may resort to DTAA. The following table depicts the taxability of an individual. Type of income. Income received in India, it is taxable for all the 3 categories: resident, not resident, ordinary resident, and non-resident. Income deemed to be received in India. As this income is deemed to be received in India, this will again be taxable in all the 3 categories. Income which accrues or arises in India, taxable in all the 3 categories. Income deemed to accrue or arise in India, taxable in all categories. And here is the change. Income accrues or arises outside India. This will be taxable only in case of ROR, who is a resident, not in case of NRs. But in case of resident but not ordinary resident, there is a term and condition that if a business or business control or profession setup is outside India. For business or profession which is controlled from India, again, in case of RNOR, the income will be taxable. Further, once the income is taxed on accrual basis, the same shall not again be taxed on receipt basis, which is a general law. Now let us see what is income deemed. What do we mean by income deemed to be received in India and income deemed to accrue or arise in India? As per Section 7 of the Act, the following income is deemed to be received in India. Contribution to recognized provident fund. This is just a list of income which is deemed to be received in India. First is contribution to recognized provident fund, employer contribution to national pension scheme under Section 80 CD. Income deemed to accrue or arise in India, Section 9. All income accruing or arising, whether directly or indirectly, through or from any business connection in India, or through or from any property in India, or through or from any asset or source of income in India, or through the transfer of a capital asset situated in India, except where he's a non-resident, or purchases the goods in India for the purpose of export, not being a citizen of India, from shooting of an cinematic film in India, salaries earned in India, dividend paid by an Indian company outside India, interest, royalties, fees for technical services payable by Government of India, interest, royalty, and fees for technical services payable by resident of India, except for the debt utilized outside India or earning source outside India, interest, royalties, and fees for technical services payable by a non-resident on the debt utilized in India or earning source in India. So this was just a list. I have not discussed this in detail. Main focus of the presentation will be determination of a residential status of an individual taxpayer. And this is the major amendment which has happened in the finance bill. So I've highlighted it separately in the presentation. I would just like to read how and when the bill had got the assent of the president. The finance bill introduced in India on Feb 1, 2020 had a clause to tax the stateless person. This led to a lot of confusion, and therefore the Finance Ministry of the Government of India in its press release dated Feb 2 clarified that in order to avoid any misinterpretation, it is clarified that in case of an individual Indian citizen who becomes deemed resident of India under the proposed provision, income earned outside India by him shall not be taxed in India unless it is derived from an Indian business or profession. And as mentioned earlier, necessary clarification if required shall be incorporated in the relevant provision of law. This was the press release that the foreign income earned will not be taxed unless it is earned by a business or a profession which is set up in India. The Finance Act 2020, which received the presidential assent on March 27, 2020, has addressed the issue. The provisions are applicable from financial year, from assessment year AY 21-22. Let us see the provisions of resident and non-resident as existing before and after the amendment. So basically, this is the residential test of an individual resident for AY 2021. An individual is said to be resident. I have also prepared a brief flowchart at the end of the presentation for better understanding. We will just read out this once and go to the flowchart. An individual is said to be resident in India if he is in India for 182 days or more during the previous year. An individual is said to be resident in India if he is in India for 60 days or more during the previous year and he is in India for 365 days or more in 4 preceding years. Where a citizen of India leaves India as a member of crew of Indian ship for the employment outside India, an individual is said to be resident in India if he is in India for 182 days or more during the previous year and he is in India for 365 days or more in 4 preceding previous years. For citizens who leave India as a member of crew of a foreign bound ship leaving India, the period enter into continuous discharge certificate (CDC) as joining and signing off by the individual of the eligible voyage, which has either originating port or the destination port in India, is excluded to determine the period of stay in India. This is as per rule number 126 as mentioned. Or where a citizen of India or a person of Indian origin visits India, an individual is said to be resident in India if he is in India for 182 days or more during the previous year and he is in India for 365 days or more in 4 preceding previous year. And from AY 21-22, where a citizen of India or a person of Indian origin having Indian sourced income exceeding rupees 15 lakhs during the previous year visits India, an individual is said to be resident in India if he is in India for 120 days or more during the previous year and he is in India for 365 days or more in 4 preceding previous year. Deemed residence. For deemed residential status, no stay in India is required. This is also applicable from the latest financial year from AY 21-22, that is from the financial year 2021. Individual citizen of India having Indian sourced income exceeding rupees 50 lakh during the previous year, if he is not liable to tax outside India on account of his domicile, residence or similar criteria, shall be deemed to be resident in India for that previous year. So these are basically 6 clauses of how an individual is being resident. Further, if he's resident, we have to check if he's a resident and ordinary or not ordinary. For not ordinary, for an individual to be a resident but not ordinary resident, there are 4 clauses. For AY 2021, this is the existing one. An individual is said to be non-resident if he is an NRI in 9 out of 10 previous years preceding that previous year. An individual is said to be not ordinary resident in India if he is in India for 729 days or less during the 7 preceding previous years. From AY 21-22, where a citizen of India or a person of Indian origin having Indian sourced income exceeding rupees 15 lakhs during the previous year visits India, an individual is said to be non-resident India if he is in India for 120 days or more, but less than 182 days or more, but less than 182 days. So basically, if a person of Indian origin or citizen of India is having income more than 15 lakhs, and if he stays in India for more than 120 days, but less than 182 days, he is said to be a resident, but not ordinary resident. From AY 21-22, a citizen of India is said to be not ordinary resident in India if he is deemed resident as above. A person who is neither a resident nor an ordinary resident, as also stated above, if he does not satisfy condition A or B, he directly becomes a non-resident in India for that particular financial year. So here is the flow chart. How the status of an individual will be resident. There are 6 conditions basically. 6 conditions of how an individual will be resident. First is stay in India for 182 days or more in any financial year. Stay in India for 60 days in that financial year and 365 days or more in the last 4 financial years. If he leaves India as a member of a crew or for employment, he must have been stayed in India for 182 days or more in that financial year, plus 365 days or more in the last financial years. Indian citizen or person of Indian origin visits India for 182 days or more in that financial year, plus 365 days or more in the last 4 financial years. If is Indian citizen or person of Indian origin having Indian income more than 15 lakhs, visit India for 120 days or more in that financial year, plus 365 days or more in the last 4 financial years. This is applicable from AY 21-22. So he will be a resident. Also, he is a deemed resident, that is Indian citizen having Indian income more than 15 lakhs in a financial year, not liable to tax outside India due to domicile residence or similar criteria. The last 2 provisions are applicable from AY 21-22, and how a status of an individual will be resident but not ordinary resident. If he is an NRI in 9 out of 10 previous years preceding that financial year, if he is in India for 729 days or less during 7 previous years preceding that financial year, if he is an Indian citizen or a person of Indian origin and has Indian income more than 15 lakhs, visit India for 120 days or more, but less than 182 days in that financial year. This is applicable from AY 21-22, and he is an Indian citizen and deemed resident as above. So these are basically the provisions of how in detail you determine the residential status of an individual, and depending upon his residential status, you further go for the taxability of the following categories of persons: resident but not ordinary resident, and non-resident. Further, a clarification was made by government by the circular number 11 dated 8th May 2020. The circular is as follows. I'll just open the circular. The circular is as follows. Here it is not visible clearly. I'll just try to open the main link. So this was circular number 11 of 2020. Government of India, Ministry of Finance. The major this circular was issued basically for clarification in respect of residency under Section 6 of the Income Tax Act. This was due to the novel COVID-19 outbreak. There were some clarifications which needed to be made. So I will just jump on to the main conclusion, which is as follows. Various representations have been received stating that there are a number of individuals who had come on visit to India during the previous year 1920 for a particular duration and intended to leave India before the end of previous year for maintaining their status as non-resident or not ordinary resident in India. However, due to declaration of the lockdown and suspension of international flights owing to the outbreak of novel coronavirus COVID-19, they are required to prolong their stay in India. Concerns have been expressed that this extra stay in India may make them resident of India. So, in order to avoid the genuine hardship in such cases due to this coronavirus COVID-19 outbreak, the board, in exercise of its powers conferred under Section 119 of the Act, has decided for the purpose of determining the residential status under Section 6 of the Act during the previous year 1920 in respect of an individual who has come to India on a visit before 22nd March 2020 and has been unable to leave India on or before 31st March 2020, his period of stay in India from 22nd of March to 31st of March shall not be taken into consideration. Those days will not be counted as stay in India. Second, for those persons who have been quarantined in India on account of novel coronavirus COVID-19 on or after 1st March 20 and has departed on an evacuation flight on or before 31st March 2020 or has been unable to leave India on or before 31st March 2020, his period of stay from the beginning of his quarantine to the date of his departure or 31st March, as the case may be, shall not be taken into account. Even this period will not be counted as stay in India. And for lastly, for those persons who has departed on an evacuation flight on or before 31st March 2020, his period of stay in India from 22nd March 2020 to the date of his departure shall not be taken into account. So basically, this was the circular number 11, which was clarified by the government on because of this novel coronavirus outbreak. Coming to the main presentation again. So basically, this was the clarification lastly made by the government, and this was the latest clarification dated 8th May, which was made by the government. Before concluding my presentation, I would like to thank JCF, Jain Chartered Accountants Federation Pune, for giving me this opportunity to present myself on the above mentioned topic. I would especially like to thank Mahavir sir for coordinating with me multiple times. We have rescheduled. Also in the participant list, I can see Subodh sir, from whom I have learned direct taxes, and all the other senior Santosh sir. Thank you for giving me this opportunity, sir, and letting me present today. Over to you, Mahavir sir.
Thank you, Pranay. And so, sir, are you there?
Yeah, I'm there.
Yeah, please, sir.
Yes, Pranay, it was a good presentation, very detailed. In fact, the best part, what I liked was you gave the entire history of how this residential status has evolved. Because
Yes.
My personal understanding is whenever we go through the history of the tax law, it always gives you the best clarity about
Correct.
the provisions, and it allows you to understand in what context the provisions have been brought in. So
Correct,
there is never any confusion when we go for interpretation. So that was actually a very, very good insight. You went back right from the 1922 Act till now. So good research done, very well. Presentation was nice. Only one suggestion, as even Mahavir had said, initially you were going a little bit too fast.
Yes, sir. Yes,
And
sir.
that is one problem in a webinar, that you don't see the faces of other people. So you don't know whether to speed up or speed down. So that is
Correct,
a
sir.
problem of the virtual thing. But otherwise, good presentation. Voice modulation was also good. Well done. Keep it up.
Correct, sir. And also, sir, for me, basically, as per my personal opinion, before understanding any provision, let us understand why the particular amendment was made. So what was the reason for making that amendment? So that's why I had emphasis on the history of amendments as well.
Good. Over to you, Mahavir.
Yes, thank you so much, Shah, sir, for the elaboration and evaluation of the speech by Pranay. Santosh sir, are you there?
Yes.
Yeah. The forum is open for question and answers. Does anyone have any question on the residential status? Pranay, I have one question just
Yes, sir.
to bring more clarity to subject. I
Yes,
entered India on 1st of April and I departed from India on 2nd of April. What is my
Okay.
stay in India?
1st April, sir. Can you just give me the year as well?
in year
Okay.
and for 2020, on 1st April 2020, I arrived in India, and on 2nd of April 2020, I departed from India. What is my stay in India?
So your status will be non-resident, sir.
What is my stay? Because the problem comes in counting the days.
Sir, the days of arrival and departure are to be excluded while counting. So your stay in India will be nil, sir.
No, stay in India will be 2 days. Am I right, Subhas Shah, sir?
Yes, and this is a very interesting point. There have been situations where I remember one person was there in India, and his flight was he cleared the passport control. His flight got delayed, and because his flight got delayed, the 12 o'clock हो गए रात के 12 बज गए दूसरा दिन आ गया.
Okay.
And then the very excited officer took a view कि नहीं you have completed one extra day in India. So there the court said nothing doing. This is a theoretical view. For all practical purposes, he has left. But this is a very debatable point what you have asked, because we have two views on this. There are some judgments saying the date of arrival and departure should be included. There are judgments exactly opposite saying date of arrival and departure should be excluded. So it is not a 100% foolproof. I personally would go with the logic that, okay, let's take a conservative view that at least if you are there for more than 12 hours during the day, at least to that extent we should include. Otherwise, I would prefer to exclude those days.
Because, sir, the thing is that department is also using a software, and that utility is available on income tax website also to check residential status. And if you put the dates, then it shows 2 dates.
Okay, very interesting.
But, yes, sir, there is a utility at income tax site also. But sir, there are some case laws which states that the days have to be excluded.
Just
I'm aware of those case laws. That's why I said.
I can just share the screen and show it right away. Yeah, you can check. The 1st of April 2019 and 2nd of April 2019, total stays 2 days.
Right, sir.
Recently, I faced the similar issue at appeal level, and this point stuck in my mind. Okay. Any other question? Okay, I think your presentation is self-explanatory, and there are no additional questions on the subject. Santosh sir, will you take over for explaining this new provision of MSMEs?
Yes, thank you, Mahavir. Jai Jandra to everyone. Mahavir has given me a good opportunity as a night watchman, we can say as a filler as such. But nonetheless, this is very important provision which has just recently come up in MSME related field, which is a registration of MSMEs in the form of Udyam registration. Previously, as you know, businesses were those businesses which were in manufacturing category or say service industries were supposed to register themselves under Industries Regulation and Development Act in the form of EM2, Enterprises Memorandum Part 2, or Udyog Aadhaar. So those industries which were not registered earlier as a Udyog Aadhaar, possibly they were covered under EM Part 2. But with effect from 1st July 2020, the government has issued a new notification number 2119 into bracket E, dated 26th June 2020, which is issued by Ministry of Micro, Small and Medium Enterprises, which says that those registrations which are already covered under either EM Part 2 or under Udyog Aadhaar will be henceforth cancelled, or those will be not effective, and all of those registered entities are supposed to have a fresh application and register themselves with effect from 1st July 2020. So this particular provision applies to all those parties who are either in manufacturing category or having service and are covered under service industry. The existing numbers, EM Part 2 or Udyog Aadhaar, those will be live up to 31st March 2021, and after 1st April 2021, those will be null and void. So this registration process or the scheme itself is very unique one, because it is directly related with the PAN number of the enterprise. Hitherto, what was happening, that suppose an industry which is in manufacturing sector, say they are having 3 units, unit A, unit B, unit C. For all of the units, unit A, unit B, unit C, you can have a different Udyog Aadhar number specifying different amount of investment in each of the industry or each of the unit. So there may be differences that particular unit A is having investment in plant and machinery, say to the extent of about 15 CR. So it was supposed to be treated as a large scale unit. Another unit B was supposed to be in having investment in plant and machinery to the extent of about say 7 CR. It was supposed to be a medium scale industry. And third one, the unit C, which was possibly having investment in gross investment in plant and machinery up to say only 3 CR. It was covered under small scale category. However, as under this particular Udyam registration, all of your investments at which are located at different units are covered under one single PAN, and hence they are covered under just one category, which will be according to your sizes, which is a revised one. As you, all of you know that revised definition of micro, small, and medium scale unit is there. Main part is that hitherto the investment in plant and machinery was considered on the basis of gross investment. Now it is directly linked with your ITR or Income Tax Act. So obviously this is related with your WDV. So no more there is any concept of gross investment in plant and machinery. This is a bigger difference, because they on one hand they have clubbed all of the units under one PAN in single registration, and at the same time they are waived of this particular condition of grossing up of considering just gross investment in plant and machinery, and investment in plant and machinery will be considered on the basis of your net block or WDV basis. That is main issue that we should consider. Another point is that for cost of plant and machinery for Udyam registration, it will be on the basis of invoice value less GST applied thereon. So possibly what was the thing that previously those taxes which were not able to be absorbed under duties and taxes, or say which were not able to be absorbed under GST Act, were covered under cost of machinery. However, under Udyam, they have specifically stated that these particular costs will not be applied to your cost of machinery. So net amount of your machinery is important in that case. Basic price is important. At the same time, an enterprise can file its all of the manufacturing as well as service activities in a single Udyam registration. This is very important because it may happen that some of the enterprises are having manufacturing activity as well as service related activities also in their portfolio. So they are not supposed to register for different activities in a different under different Udyam registrations. As a this is PAN based, you can just add up your investment or your manufacturing as well as service related activities in single Udyam registration. However, it is important to give you rather preference, or you will have to mention which is your main activity of business. So whether it is a manufacturing activity which is consisting of main part of your total activity, or is it a service activity, service industry related activity. On that basis, you can differ your, or you can choose your codes of business activities. Now here is one important twist as regards to the definition of plant and machinery. Items which are covered as per income tax rules, that is very important, because investment as per plant and machinery, in investment in plant and machinery on WDV basis has been mentioned, which will be a deciding criteria to decide what is your scale of business, means whether it is covered under micro or small or medium. So as per prevailing appendix 1 of income tax rules 1962, which are the items which are covered under plant and machinery is machinery and plant, motor cars, aeroplanes, motor buses, motor lorries, motor taxis, other commercial vehicles, molds, specified air pollution control equipment, water pollution control equipment, and solid waste control equipment, specified life-saving medical equipment, computers, including computer software, specified energy-saving devices, specified renewable energy devices, and other specified assets as per Appendix 1 of ATI rules. However, which are the items which are not covered, which are as per Appendix 1 of ATI rules? That is electrical fittings, electrical wiring, switches, sockets, other fittings and fans, etc. These items are covered under furniture and fittings. At the same time, items which are not covered, wells and tube wells, water treatment systems, these items are covered under building. Intangible assets, know-how, patents, copyrights, trademarks, licenses, franchises, or any other business or commercial rights of similar nature. And items which are not once again covered is ships and likes, mainly used for dredging purposes and fishing vessels and vessels operating in inland waters. At the same time, there are certain other items which are not covered under section 7 subsection 1 explanation 1 thereto of MSMED Act. This is very important that you can exclude these items from your WDV. Cost of pollution control devices, cost of research and development devices, cost of individual safety devices, cost of such other items as may be specified by notification. So while filling up the form, this particular data will be auto pick up by from your income tax returns which has already been filed up, as well as GST returns. So turnover as well as this cost of machinery, which is given as per WDV rates, WDV system in income tax return will be auto pick up from income tax as well as GST returns, and there will be one window in which you are supposed to exclude some amount through which you can deduct the amount of these items which are not covered under plant and machinery. So the net amount which is eligible as per Uddam registration will be covered over there. So this is important part that you should exclude these items, particularly for those registrations which are on border. Say if a particular company is having their investment in plant and machinery at WDV basis, say to the extent of 52 CR. So in normal course, it may be covered under large scale. But suppose if we can just check out what are the items which are covered under non-eligible category, and if the amount of that those non-eligible items amounts to possibly say 3 CR, then total amount, net amount of eligible assets which are covered as per Uddam registration criteria will be just 49 CR, and that unit may be converted from large scale to medium scale, and possibly they may get a huge benefit by just this deducting 3 crores of amount which is non-eligible under this particular non-eligible list of plant and machinery. So that is very important, particularly for those border cases. Then we can just check out updation of information. This is very important because a responsibility has been cast upon the entrepreneur to update its own data on yearly basis. So at each year, after filing of your return, income tax return particularly, because obviously GST return will be filed periodically throughout the year. However, after completion of year, as we normally know, we are also exercising our duty of submission of income tax return. Then we are supposed to link our this particular Uddam registration related data with our latest income tax return. So if there is any addition or deletion of assets, particularly plant and machinery related assets, accordingly your category will be fixed up, means it will be revised on each year. So this is very important part which was hitherto not specified in EM part 2 or even in Udyog registration. So Udyam registration has this particular new condition which is a responsibility cast on us. Now what are the basically benefits for us if we are registering ourselves under this Udyam registration? First of all, obviously all of you know delayed payments clause. It applies to only micro and small scale industries. Please note that it doesn't apply to medium scale industries. So those industries who are having their net WDV in plant and machinery below 10 CR, according to their latest income tax returns, those are covered under small scale industries. So they can be benefited from this particular clause. Just yesterday, there was a case of one of my clients that his total investment in plant and machinery on gross basis was up to say 14 CR. So he was just pleading me, sir, please reduce my some of the assets, some of the plant and machinery, and please bring me my case in small scale industry so that I can get my payments within 45 days only. Because as he was a vendor to multinational companies or big companies, on the basis of that, he is not covered under particularly small scale industry under previous Udyog Aadhaar. He was not entitled to benefit of 45 days credit. Means his payment payments were stretched up to say 90 days, 110 days, 120 days. So he was just reading me, sir, is there any provision? So we just check out what is his existing net WDV of plant and machinery as on today. It was about 8 CR. So obviously he has came down from large scale or even medium scale to directly small scale. So now all of those clauses which are applicable for particularly delayed payment delayed payment related issues are now applicable to him, and he can take benefit of that clause, and he can very well ask to his customers to release his payment within stipulated date. So that is very one important issue. Second thing, if anyone wants to take any kind of subsidy related benefits, say interest subvention or any other benefits which are entitled to them, this particular registration is very useful. Third thing, if there is any issue related to payments or services with your client, then you can always go for a government authority, which is a kind of quasi-judicial authority named as Samadhan. So while approaching that particular authority, you must have this particular registration number with you that you are registered with Udyam Aadhaar. Okay, these are three main benefits which we can discuss. Now, as regards to shortcomings or fallacies, the thing is that while registering this particular number or while going for this registration process, what we have observed that there are two windows that has been given on the site, which is first one is for those entities who have not at all registered henceforth previously till date, and those entities who do have either EM Part 2 registration or say Udyog Aadhaar registration. So for those entities who have not yet at all registered themselves under Udyog Aadhaar or EM Part 2, either two, those can go straight away and register their cases. Okay, by giving necessary details of the business. Main thing is that obviously your the name of the entrepreneur is first of all asked for, and his Aadhaar number is asked for, because you will get OTP on the Aadhaar, which is on the mobile, which is linked with your Aadhaar. So this linking of your mobile number and Aadhaar is very important. A fallacy has been noted in this particular part, that suppose a particular person with PAN number is having interests in different businesses in different capacities. So suppose he is a partner in a partnership firm, or a director in private limited company, or designated partner in a LLP. So he's already acting in three roles in three different businesses. Now he wants to start his own proprietorship business, and possibly all of these three businesses are registered as stating entrepreneur name of the entrepreneur of he himself only. So his PAN number has already been attached, or his Udyog number has already been attached to those three registrations. Now, if he wants to start his own individual proprietorship business, then obviously, if we are going to start it as a new entity, then when I'm just filling up my Aadhaar number, it immediately says that this Aadhaar number is already linked to other businesses. Then if I'm going to register my business as a existing category, then that particular portal asks me first question about my Aadhaar number of existing businesses. So I'm left with no choice that I can't register my business as a new entity in proprietorship capacity, either as a new entity or even in existing business also, because obviously in existing businesses they are asking first of all Udyog Aadhaar of your existing businesses. So that is the issue. In the same way, those entities which are rather having their businesses below GST threshold limit, there is a big question mark. What will be the case of this particular enterprises after 1st April 2021? Because this particular window of 9 months from 1st July 2020 to 31st March 21 has been given for those particular industries for registration which are not having GST registration. But from 1st April 2021, it is a mandatory clause that businesses must have GST number with them. Otherwise, those will be ineligible to have their Udyam Aadhaar registration. So there was a query from one of our JCAF member to me that for those particular industries, which are rather very small businesses, but obviously they are supplying their items to industries, and they are supposed to get some dues. They are rather service providers. So like there are many services. So what will be the fate of their in that case? Because their business is not supposed to be above GST threshold limit, and after 1st April 2021, they will be possibly ineligible. So possibly once again they will be facing this particular restriction about 45 days clause or like that one. So that was the issue. What I had given answer particularly for that query was possibly they will extend the date of applicability of that particular clause, mandatory clause of GST, or they may rather delete that mandatory clause at all, because there are number of units or number of cases which are covered under either say manufacturing or service industry, which are below GST threshold limits, and they are providing services to companies or say big enterprises. Also, there was one query as regards to what will be the position of businesses having trading activity as well as manufacturing or service industry related activity also. So suppose there is one vendor who is rather dealing in computer hardware sales, computer hardware items, and he is also undertaking AMC services as well as some repairing and servicing related activity. So if the total turnover of his business of computer hardware sale as well as AMC or say repairing and maintenance is about say 250 CR, he will straightway go to a club of large scale industries. So obviously he will not be getting benefit of being a small scale industry or medium scale industry as he should otherwise get. So this particular amount of sale will be picked up directly from income tax return. So there won't be any, mostly if we have not given proper breakup in our income tax return, they may face this kind of difficulties. Otherwise, whether a separate firms should be rather devised or established for these two different activities, that is a point to think on. Also, there are certain other issues which were pondered upon, but practical difficulties are there, particularly for those cases which are having already EM Part 2 or Udyog Aadhaar. If we are as of today going for registration, we can just give our existing Aadhaar number or EM Part 2 number while converting into Udyam Aadhaar, and this particular portal says that you can just wait for some of the days, after which we will contact you. I think there are some systems yet to be developed at the backside of this particular website or say system related issues. So we think that in coming days this will be much more improved and there will be more clarity on this one. But one thing is sure, that we must go for this kind of registration. It is rather beneficial in all of our interests. So this is my presentation. Thanks to JCAF Pune, Mahavir, and all of you for patient hearing. Thank you.
और कुछ सर?
I think it's
सबको thank you हो गया.
It's enough just for
कोई question है क्या? Hello, anybody is having any question? You can unmute yourself. We are a small group now. Okay, sir, मुझे question था. In case of Tushar. Yes, Tushar.
Okay, you ask your question.
Okay, thank you, Tushar. Sir, मुझे question था. Builder के case में, where there is actually no plant and machinery as of his own. Basically, he is using all rented plant and machinery. Then what should be the amount mentioned there?
You must be having some of the computers with yourself.
Yes, computers. That's a negligible amount. Yeah.
Yeah, that you can show computers, calculators. Even in the case of CS, what kind of plant and machinery do we have? That is in the form of just means as we are mentioning in our income tax return. It can be either say computers, calculators, or like things. If you are covering this particular items under office equipments, then you can very well club it under plant and machinery. If you are not having your own construction related plant and machinery, that can be your best for plant.
So it will mean that even a large scale builder will also end up being a micro entity.
Yes, by all means.
This kind of problem we also face while giving the certification for this Maharashtra Pollution Control Board.
Yes,
because their fees is dependent upon this plant and machinery amount.
They are considering their fees on the basis of gross value of total block of your assets, and not only on plant and machinery. So no, all of the
assets. There is specifically building and machinery only, not for other assets.
No, the certificates that we were asked for and which has been given were as far as MPCB is related, on the basis of gross investment in all assets, even including
yes, gross investment. Even I think they are considering the future investment also for this Maharashtra Pollution Control Board.
Yeah,
but
on the basis of that,
ultimately it is about the value of plant and machinery only.
No, but they are taking fees on the basis of total investment in your fixed assets.
Total investment. Okay.
Yes.
We'll
Because
check it.
obviously, yes.
Because investment in plant and machinery, what they say in that certificate, it's gross. That's right. But the same problem comes here also, because the under construction building is not a plant and machinery in any sense.
No, it is obviously not at all.
And builder is not having any plant and machinery of his own also.
Yes.
I think that form is specifically meant for industries, and it is made somehow applicable for builders also.
Possibly it is correct, but the thing is that you can also cover your computers plant as a plant and machinery one.
Right.
Correct.
So all builders are micro entities, and we need to pay them within 45 days.
Obviously, it is expected.
Yes, sir. Any other question?
Yes, Santosh sir.
Yes, Tushar.
See, in case of a service provider, if he is having a WDV of say around 40 lakhs as on 31st March last, out of which 2 lakhs is the WDV for computers and this office furniture, and 38 lakhs is for BMW WDV, BMW car. So will that car be included, because it is a asset, of course, which he's using, and it's a business asset. We are claiming depreciation on it. So
yes, just I am
cars
just
are specifically excluded, I think, no, from definition.
No. The thing is that in this particular Uddam registration, items which are covered is, once again I will repeat it, plant and machinery, and this is as per Appendix 1 of income tax rules. Machinery and plant, motor cars, aeroplanes, motor buses, motor lorries, motor taxis, and other commercial vehicles, molds, specified air pollution control equipment, water pollution control equipment, solid waste control equipment, specified life-saving medical equipments, computers including computer software, specified energy-saving devices, specified renewable energy devices, and other specified assets as per Appendix 1 of IT rules. So obviously motor cars are covered under plant and machinery as per Appendix 1 of income tax rules. So this particular Appendix 1 has been attached to this Uddam registration. So even if in your case the cost of machinery is say just 2 lakhs and the cost of BMW is 38 lakhs, still from a plant and machinery point of view for Uddam registration, the cost of plant and machinery on WDV basis will be 40 lakhs.
Okay. And earlier, during that MSME regime, was that car covered?
No, earlier it was not covered, because in that case particularly, those items which are directly related with your manufacturing activity were covered, excluding once again some of the items under MSMED Act, which were pollution control devices, research and development devices, and industrial safety devices.
Okay.
So previously it was not attached with our Appendix 1 of income tax rules. Now it has been attached to Appendix 1 of income tax rules. Hence, all of these items are covered under plant and machinery.
Okay.
In that case, if you are taking half of depreciation as your personal expenses disallowed, in that also the value of that asset will be taken as full or half, 50%.
No, whatever has been mentioned by you in your income tax return will be directly auto pickup from IT database.
Okay, auto pickup.
Yes, it will be auto pickup.
How it can be auto pick? Because the PAN number will be different, no? For
this will be PAN based. This total registration is PAN based.
This registration is PAN based, but PAN number will go for one individual only, no? If I am a partner in some firm, then my PAN number will go there, or that firm PAN number will go there.
No. If you are registering in the name of your firm, then obviously firm's IT data will be picked up from income tax database.
Okay, so
if I am having one industry and I'm having different locations, suppose my factory is say located at say Chakan, and I'm having some say showrooms at different places, and I'm showing all of these assets like say computers, calculators, and other things which are located at different showrooms, as well as investment in plant and machinery as per Appendix 1 of income tax rules in Chakan under one head. under Income Tax Act or say IT return, in that case, obviously the whole of the amount of plant and machinery as has been shown in my income tax return will be auto pickup. So there won't be any breakup as regards to whether it belongs to your branches or showrooms or whether it belongs to your factory. So the whole amount of will be directly auto pickup, and on that basis, your investment criteria, as far as investment in plant and machinery is concerned, will be checked. Obviously, while giving information as regards to our income in P&L account in income tax return, we do have options as receipts from business, receipts from services. If we are giving proper breakup in that particular clause, then receipts from services can be directly picked up for identifying case of those businesses which are having trading as well as service related activities under one roof.
Mm-hmm. There will be some issues as regards to 44 AD submissions where books of accounts are not maintained and depreciation.
There will be issues. There will be issues.
Hmm.
But as you have just told that in the case of builder, due to particularly business turnover, possibly the criteria may get changed. It's from small to medium or say medium to large also, depending on the amount of turnover that can be picked up directly from your income tax database.
Okay. Yes, sir. और किसी को कोई क्वेश्चन है?
One question to Pranay.
Yes, sir.
Tushar, have I answered your question?
Yes, definitely.
Yes, Tushar, sir.
You said that in case of a resident but non-ordinary resident, RNOR, income accruing or arising outside India but then derived from a business controlled from India or a profession set up in India. So can you give an example so that what kind of business is covered and what kind of business is not covered? Like it's a subjective matter altogether as to decide whether it is controlled from India or set up in India. How to decide, like, or can you cite an example?
So there are clarifications on how the business or setup or a profession which is set up in India, how to determine that also. For example, sir, you can say I'm a RNOR and suppose I'm working for a company abroad, some outside India, and that company is a subsidiary of an Indian company, for example. So the subsidiary company is generating revenues from the Indian company which is set up in India. So that is an example, sir, कि जहाँ पे business or a setup is controlled from India.
Okay.
No, I think Pranay, we are talking other way around. The provision says if your income from business activities in India is more than 15 lakhs, then you are covered into this residential new guidelines. In that case, I think that person must be outside India for more than 180 days, 182 days or more. And that is the primary condition why he is not fulfilling that residential criteria. And he is controlling something sitting outside India, a business entity running in India. It is like that.
Sir, I think Tushar sir is asking example for a business or setup or a profession which is set up in India. So
Yes.
15 lakhs to sir, it is from this financial year only, the amendment. So even if he is not in India or say for more than 120 days but less than 182 days, and he is having some income which is accruing from a business set up in India. Suppose generally the phenomena is like that NRIs have multiple investments in India and they are earning returns on them also. So those all things are also covered, sir, which is a business or profession set up in India. Say NRI can be a partner in some project or something like that.
Okay. Yes, that can be a good example.
Yeah.
If he's a partner in any of the projects, then the income is directly there. It is earned in India only.
Yes, sir. But for sir, for the purpose of language, uske liye to, it will be like a business set up in India. So NRI ka main business is not being a partner in say construction sites and something like that. So purpose of the language will be for a business set up in India.
Okay.
Yes, sir.
Okay. Any other question? जयेश जैन, प्रणय, तुमको नो क्वेश्चन. चलो अभी शायद पार्टिसिपेंट भी 5 ही बचे हैं, तो we'll end this session here.
Okay, sir.
Yes.
Sure.
Yes.
So thank you very much, everybody.
Thank you, sir.
Thank you, everyone.
Thank you so much.
Thank you.
Yes,
Thank you.
Thank you.
Bye.
Thank you.
Right.